Hi, I'm Megan Russell, and this is my financial analysis for Finance 653. For this project, we had to choose 3 industries with 5 companies in each and analyze the financial ratios over the past 5 years, as well as analyze the industry as a whole. I chose the entertainment, travel services, and airlines industry. Under the entertainment industry, we have Disney, Discovery, Fox, Time Warner, and CBS. Under the travel services industry, we have TripAdvisor, Trivago, Travelzoo, Expedia, and Priceline. And under the airlines industry, we have Delta, JetBlue, Southwest, American Airlines, and Alaska Airlines. We will begin with the entertainment industry. What's going on in the entertainment industry? Well, Fox now tracks viewership ratings occurring after 3 and 7 days to include the popularity of on-demand viewing. More people are choosing to stream video through online services and forgo traditional cable or satellite TV subscriptions. 78% of people say they subscribe to at least one online streaming website, and networks must produce a steady supply of original content that create fan bases in order to stay relevant with distributors and advertisers. We will now begin looking at the financial ratios for the entertainment industry. We will start with the short-term solvency. Looking at Disney, we see they have been consistent over the past 5 years, with having a lower cash ratio than the rest of the others. Moving on to the Discovery short-term solvency, we see they have had a decrease from 2012 to 2014 and then had an increase in their current and quick ratio from 2014 to 2015. We have moved on to Fox and Time Warner. Fox had a decrease in all 3 of their ratios from 2012 to 2014 and then saw an increase from 2014 to 2015 and a decrease from 2015 to 2016. Time Warner remained consistent, however, they had a really low cash ratio. Finally, we have CBS, who has seen an increase from 2015 to 2016, but who's had the lowest cash ratio. As we analyze the current, quick, and cash ratios of the entertainment industry as a whole, we see that Fox has had the highest current, quick, and cash ratio of all 3. Disney had the lowest current and quick ratio, and CBS had the lowest cash ratio. Discovery had a decrease from 2012 to 2014 in both their current and quick ratios, and a decrease from 2012 to 2013 in their cash ratio. While Time Warner remained consistent across the board for all 3 of these ratios. We've now moved on to long-term solvency, where we see that all of the companies in the entertainment industry have increased their equity multiplier. However, CBS had a major increase from 2014 to 2016 in their equity multiplier, while Disney remained with the lowest equity multiplier of all the companies. As we moved on to the times interest earnings ratio, we see that Disney is well above the others when it comes to this one. Discovery, Fox, Time Warner, and CBS all remain low on this ratio. We've now moved on to the total asset turnover, where you can see that Disney had the highest total asset turnover and CBS was right behind it. Fox had an increase in their total asset turnover from 2012 to 2014, while Time Warner and Discovery pretty much remained equal with each other. We moved on to the profitability ratios, where you can see CBS had a spike in their profit margin, ROA, and ROE from 2013 to 2014, and then a decline in their ROA and ROE from 2014 to 2016, and a decline in their profit margin from 2014 to 2015. Discovery remained the lowest of all three ratios within the industry, while Time Warner, Fox, and Disney remain consistent with each other, increasing their profit margin, ROA, and ROE. The entertainment industry's market value ratios, as we look at the price to earnings ratio, we see them increase from 2012 to 2013, and then all the companies in this industry had a decrease from 2013 to 2015, while CBS was the only one to have an increase from 2015 to 2016. The market-to-book ratio showed that all the companies in this industry had an increase in their market-to-book, while CBS had the biggest increase in 2015. Enterprise value shows that Disney is well above the other ones, while Fox and Time Warner are in the middle, and CBS and Discovery are on bottom. When looking at the enterprise value to EBITDA, we see that the companies are competitive with one another. We've now moved on to the WACC ratios for the entertainment industry. The entertainment industry has seen an increasing ROIC, however, they have seen a decreasing WACC ratio. As far as the EVA and EVA spread, CBS and Fox had an increase from 2012 to 2013 and then saw a decrease in these ratios. Discovery was on the bottom for EVA and EVA spread, and Disney has increased both of the EVA and EVA spreads. We finally moved on to the free cash flows. As you can see, Disney is well above the other companies in terms of free cash flows. Time Warner and Fox remain in the middle, and CBS and Discovery remain on the bottom. For this project, we had to choose the one company in each industry that we think was the best as a whole. I chose Disney. I think Disney is most consistent across the board. It's used the least debt and brought in the largest earnings. It's good with its total asset turnover, stable in its profit margin, ROA, and ROE, and has increasing free cash flows. Now we're moving on to the travel services industry. So what's going on in the travel services industry? Well, mobile purchases account for over 25% of travel revenue. Travel services offer bundles in order to get customers to spend more money. Travel services must make everything easy and convenient for the consumer. They will bend over backwards to satisfy a modern traveler. Millennials are used to having their options and comparing them against others, so each provider must offer the best price to gain that customer's purchase. The best travel sites will include hotels, cars, flights, event tickets, and reviews on activities of what to do when visiting your location. We'll now begin looking at the financial ratios for the travel services industry. We start with TripAdvisor, who saw a decrease in their current, quick, and cash ratio from 2012 to 2014, an increase from 2014 to 2015, and then a decrease again from 2015 to 2016. Trivago is different because their company began in 2014, and since then, in 2015, they've seen an increase in their current, quick, and cash ratios. We move on to short-term solvency ratios for Travelzoo and Expedia. Travelzoo has been up and down over the past 5 years. However, they've remained between 1 and 2 in terms of their short-term solvencies. Expedia has seen a decrease in all three of their current, quick, and cash ratios from 2012 to 2014, while having a very low cash ratio. Finally, we look at Priceline. Priceline has increased from 2012 to 2013. However, since then, they've had a decrease in their current, quick, and cash ratios. Now we move on to current, quick, and cash ratios of the travel services industry as a whole. As you can see, Priceline was well above the others for their current, quick, and cash ratios, while Expedia remained consistent on the bottom. TripAdvisor and Travelzoo remained in the middle, while Trivago had a spike in 2015 because it had just begun. We move on to long-term solvency. Travel Services Equity Multiplier shows that Expedia had the highest equity multiplier, while Travelzoo is right behind it, and TripAdvisor saw a decrease in their equity multiplier from 2014 to 2016, while Priceline saw an increase in their equity multiplier from 2014 to 2016. We now move on to the times interest earnings ratio to show that four of the companies in this industry are competitive with one another, while Trivago has had negative times interest earnings ratio from the time it began. The total asset turnover ratios shows that Travelzoo is well above the others with this ratio, and they're continuing to increase. In fact, they've increased from 2014 to 2016. Priceline has seen a decrease in their total asset turnover from 2012 to 2015, and TripAdvisor has remained pretty consistent across the board. We now move on to the profitability ratios to show that Priceline is well above the others in terms of the profit margin, ROA, and ROE. However, they have seen a decline in all three of these ratios. Trivago still remains the lowest, and Expedia remain consistent, but TripAdvisor saw a decline in all three of these ratios. We moved on to the market value ratios to see that TripAdvisor increased their market value and price earnings ratio from 2012 to 2013, and then it decreased from 2013 to 2014. Priceline was consistent over their price to earnings ratio and their market to book ratio, while Travelzoo had the lowest price to earnings ratio. As far as enterprise value goes, Priceline was well above the others, while TripAdvisor and Expedia remained in the middle, and Travelzoo and Trivago were on the bottom. Now, when comparing the enterprise value to EBITDA, we see that all the companies in this industry, except for Trivago, are competitive with one another. Trivago has had a tremendous spike in 2015. We now look at the WACC ratios. Once again, all the companies remain very competitive in the WACC ratio, except for Trivago, who saw a spike. And looking at the ROIC, Travelzoo had a dramatic drop from 2012 to 2013, and the spike from 2013 to 2014. Priceline had a decline over the past 5 years, as well as TripAdvisor, while Expedia remained consistent. We now move on to the EVA spread, showing that Travelzoo has been all over the place, while TripAdvisor saw a decline, and Expedia also saw a decline, and Priceline did too. We move over to the EVA to show that Priceline is well above the others. However, they've had a decline from 2015 to 2016. Expedia has had a negative EVA from 2014 to 2016, and Travelzoo and TripAdvisor have remained competitive with one another. We now move on to the free cash flows for the travel services industry. Once again, Priceline is well above the others, and they've actually been increasing this time from 2012 to 2016. Expedia has been up and down, while TripAdvisor and Travelzoo have remained consistent. I chose TripAdvisor as the best company because of their consistency in the liquidity, long-term solvency, total asset turnover, enterprise value to EBITDA, and WACC ratios. Up next, we will analyze our final industry, the airline industry. What's going on in the airline industry? Well, consolidation of airlines in the U.S. has boosted market share among the 5 largest U.S. carriers. Airlines in the U.S. and most other regions are enjoying a run of good results due to rising demand and extended drop in fuel prices. Industry-wide passenger traffic grew by 6.3% in 2016. Commercial airlines posted their strongest financial performance ever in 2016, reporting a $3.6 billion net profit. Airline executives know that the results they are enjoying will now attract heightened competition and new players. Falling ticket prices are still a challenge, however, and airlines will have to build extensive digital marketing capabilities to stand out in a crowded market. We'll now analyze the financial ratios for the airline industry. Looking at short-term solvency first. Delta has remained pretty consistent across the board over the past 5 years, with its current ratio being relatively high. JetBlue has also seen increases from 2013 to 2016. We moved on to Southwest and American Airlines. Southwest saw a decrease from 2012 to 2015. However, they've seen an increase from 2015 to 2016. American Airlines, however, increased from 2012 to 2013 and saw a decrease from 2013 to 2016. And finally, we have Alaska Airlines, who has seen a decrease in their short-term solvencies from 2012 to 2016. We will now compare the current quick and cash ratios of the airline industry as a whole. Alaska is well above the others for all three of these ratios, while Delta has the lowest quick and cash ratio, and American, Southwest, and JetBlue have remained consistently in the middle and competitive with one another. Moving on to long-term solvency, we see that Delta had a spike in their equity multiplier in 2012, and American Airlines had a spike in 2014. Alaska, Southwest, and JetBlue remain competitive and consistent with their equity multiplier. We moved on to the times interest earnings ratio to see that all airlines have increased this ratio from 2013 to 2016, while Southwest has had the most increase of them all. The total asset turnover shows that Southwest managed its assets most efficiently, while Alaska Airlines is right under it. American Airlines has been up and down since 2012, from 2012 to 2016, and JetBlue and Delta, although they have been consistent, have been on the bottom. Moving on to the profitability ratios, we see that Delta had a spike in 2012 and a drop in 2014 in all their profit margin, ROA, and ROE. American Airlines had a spike in 2014 and a drop in 2016 in the profit margin, ROA, and ROE ratios. Alaska, JetBlue, and Southwest have seen increases in their ROA, profit margin, and ROE over the past 5 years. Moving on to the market-to-book ratio, we see all the airlines increased their price to earnings from 2012 to 2014 before having a drop in 2014 to 15 and then an increase in 2015 to 16. As far as the market-to-book ratios goes, American Airlines had a spike from 2013 to 2000 and then a decline in 2015, but all the other companies remain competitive. Looking at the enterprise values, we see that all the airlines have increased their enterprise values over the last 5 years. All the airlines have increased their enterprise value to EBITDA from 2012 to 2014, declined from 2014 to 2015, and then increased again from 2015 to 2016. We now moved on to the WACC ratios to show that all the airlines are pretty competitive in terms of this ratio. Same thing with the ROIC ratio, except Delta had a huge increase from 2012 and then a huge decline from 2014. Other than that, the companies have remained consistent with one another. The EVA spread shows that Alaska Airlines has been up and down over the past 5 years, while Delta had an increase in 2012 and then declined from 2013 to 2016. Southwest has been increasing their EVA spread since 2013, and they've also increased their EVA since 2013. JetBlue and Alaska Airlines have been on the bottom for the EVA spread, while American Airlines saw a spike in 2014 and a drop in 2016, and Delta Airlines saw a spike in 2012 and a drop in 2014 for their enterprise value. Finally, we look at the free cash flows to see that Delta is well above the rest in terms of free cash flows. Southwest is next, and Alaska and JetBlue are in the middle. We see American Airlines has had negative free cash flows. I chose Southwest as the best company because they're consistent with their liquidity, equity multiplier, profitability, and market-to-book ratios. Southwest is increasing in their profit margin, ROA, ROE, times interest earning, total asset turnover, and all WACC ratios. Now I'm going to compare the two companies I think were the best out of their industries, Southwest and Disney. Southwest was consistent with their liquidity, total asset turnover, and market to book. They're increasing profitability, free cash flows, and all WACC ratios, and they have a low equity multiplier and a high times interest earnings ratio. Disney was consistent with their liquidity, profitability, and total asset turnover, and they have high free cash flows. Now, overall, I think Southwest was the best company because looking at their financial ratios and the industry as a whole, Southwest looks to have the best future. People are traveling more, especially with lower ticket prices, and Southwest has financial ratios that are increasing, which show promise in the future.